We have some mixed performances so far in the S&P 500, but today our focus is going to be on 5 dividend stocks that have been absolutely hammered over the last 12 months. Should we start buying them now? Do they have some massive upside? Let's find out. The first one that we have today is Nike. Now this one, no surprises if you've been following it, negative 32% just over the last 12 months. If you've been a shareholder over the last 10 years, well, you would be up 92%, and we can see all-time highs sit around $178. That is more than $100 higher than the current trading price. As we can see right now, trading right there towards its 52-week lows. We get one buy rating, that is from Wall Street, with a double hold from Seeking Alpha and Quant. We also note the forward yield now sits above 2%, and the forward P at 23 is not far off the S&P 500. Now, when we talk about these companies, we also want to see how have they performed against management estimates over the past. What we notice with Nike is that they have beaten analyst targets over the last 4 quarters, 100% track record. That is nice to see, but do note over the next 4 quarters, they are anticipating double-digit negative growth to their earnings per share year on year. But if you do look far out to May 26, they are anticipating that forward P to come down to just over 20. Now, in terms of this company, first things first, dividend safety score 99, the highest score obtainable, and they have increased that dividend November last year, high single-digit growth, which is what we want to see. And in terms of the last recession, well, in fact, they increased the dividend during the 07-09 crash. They had above average growth, negative 7%. Bear in mind, S&P was around negative 12, but they did significantly outperform, negative 36, S&P coming in at negative 55. One thing we do like about this company are the nice increases to the dividend, double digit over the last 5 years as well as double digit over the last 20. And when we take a look, they are 22 years of paying a consecutive increase to the dividend, 3 years away from becoming a dividend aristocrat, with 40 years of paying a dividend without a reduction. Now, those that are new to the channel, we always take a look at dividend yield theory. It states a company is undervalued when the current yield sits above the 5-year average. So this is our first sign of undervaluation. Another sign, severe undervaluation, the forward P 23, significantly lower than the 5-year average of 31.9. We also note the consumer discretionary, however, is much lower at 13.9. But remember, this is a bucket of companies, therefore there are a lot of poor quality companies within this as well. In terms of the free cash flow payout, as always, it is something that we like to focus on. Below 60%, we always use that. That does give us faith. Management can offer double-digit increases we love to see. And what we note over the last 10 years, below 60% every year, bar that COVID year, 42% over the last 2 years, 49% over the next 12 months anticipated. So we would expect that increase of dividends at a very favorable rate to continue. As always, free cash flow, we want to invest in companies that increase it over the longer term. There is a bit of inconsistency with Nike. The one thing we would mention as well is that over the next 12 months, it is anticipated to come down. But again, you will notice from the share price, it has dropped significantly, and they have also lowered their forward guidance. In terms of the sales growth, well, 3 to 7% when we do look at a deep dive, look at companies' income statement. Not too bad. We do notice the COVID drop of negative 4%, which actually wasn't that bad when you compare it to other companies. However, 2024, we have noticed their top line was flat from the prior year. In terms of numerics, though, we do notice some nice growth, 31 billion to 51 in 2024. On top of the nice increases to the dividend, they also return that excess cash by doing those share buybacks. We can see these shares outstanding reduce. Ultimately, this does give you a larger portion of the company that you do hold. ROIC, one of the most important metrics, 10% or more, that is the minimum we look for. Give us the faith management are able to effectively allocate their capital, and we can see very high numbers consistently year on year. As always, that does make it very attractive for potential investors who are considering adding this to the portfolio. In terms of the margin, well, operating, what we really want to see ideally is increasing operating efficiency, increase the revenue, but also the margin. Not something we see from this company, pretty much flat around the 12 to 13% year on year. In terms of the free cash flow margin, above 5% is what we want to see, pretty much what we get consistently, 10% over the last 2 years. Now, finally, with this company, we always like to look at the net debt to EBITDA. Below 3, now remember these are the number of years it would take the company to pay off all of their debt net of cash on hand, and it correlates to both dividend safety, balance sheet strength, 0.05 in 24, 0.06 over the next 12 months. It has a fantastic balance sheet. No surprises when we consider this with the free cash flow payout, why they also have that 99 very safe dividend score. Now, our intrinsic value in today's episode comes to just over $100. As always on this channel, when we look at individual companies, we do a deep dive, we run through every single model. Today, getting straight into it, at $100, we always use a margin of safety or MOS. 10% is what we start off with. We execute on that if we believe it has a wide moat, strong financial metrics, good forward-looking data. And there's always discussions in the comments about whether or not a company like Nike has a wide moat. But remember, 10% is what we start off with. So that is a buy at $90. 15% at 85, 20% it would be around 80, and in today's episode we see a 25% MOS up to $75, but again these are based on the estimates and judgments that we have gone through in the model. In terms of Wall Street, they see $94 over the next 12 months, upside of 27%, and as we go along today in these beaten down stocks, give us your thoughts on whether or not you are buying, or in fact you may see them as a falling knife. Now before we continue, just to let you know, we have released our latest 2 articles this week. We have the paid version where we run through 55 dividend growth stocks with our spreadsheet detailing our buy prices, as well as a free one running through 5 undervalued growth stocks. As always, you can grab a copy of these and other articles by clicking on that pinned comment below and reading them straight away. The next one we're looking at is Estee Lauder, now trading at $100, down 47% over the last 12 months. Over the last 10 years, you still would be up around 33%, but it has come all the way down. In fact, a downward trend since the highest December 21 at $370. That is nearly 4 times the current trading price. No surprises then, trading at its 52-week low. We have a bit of a pick and mix, a buy from Wall Street, a hold from Seeking Alpha, and a sell from Quant. In terms of a forward yield, well, 2.66%. Forward PE just over 44. But as always, let's take a look at their earnings and see the estimations moving forwards. Nice to note, always gives me confidence. Last 4 quarters, they have beaten on the EPS. When we look at the next 2, they're expecting triple-digit growth to the EPS year on year, and even the subsequent 2 double digits. So if they do hit that in June 2025, the forward PE will come down to around 24.57. In terms of the dividend safety, well, 50 borderline safe. They haven't increased that dividend as well since November 2022, something to bear in mind. Effectively, what this borderline score means, and this was downgraded, in fact, just last week, that there is a moderate risk of a dividend cut over a full economic cycle. In terms of the key metrics, well, they maintained the dividend during the last recession, no increase but also no cut, average growth, and also a near S&P return. In terms of dividend growth, whilst they haven't increased it since November, over the last 5 and last 20 years, they have historically increased double digits. No surprises then, only 3 years of consecutive increases. In terms of dividend yield theory, we do get a strong double undervaluation signal. In fact, it is the highest yield they have offered over the last 5 years and one of the lowest forward Ps they've traded at over the 5. In terms of sector P though, consumer staples does sit much lower at 17.5. We then move on to the free cash flow payout. Below 60% is where it has been every single year over the last 10 years, although we do want to point out over the next 12 months, they are anticipating this to be 72%. Whether or not we see an increase, that is something just to bear in mind, as they haven't increased it in quite some time. In terms of the free cash flow, well, first thing to point out, negative in 2023, but they are expecting this to increase to positive 369 over the next 12 months. And historically, it has increased over the longer term. Just depends on whether or not you do believe this negative free cash flow was a one-off in 2023. In terms of sales growth as well, not the greatest in the more recent year. 3 of the last 10 years negative, as well as 2023 at negative 10%. So when we do look at the numericals of this company, it has increased, although marginally, from 11 billion to 16. Ideally, we'd want to see at least double over the longer term. They do share buybacks very minimally. We don't talk too much about it as it hasn't come down a lot, but it is something that they inconsistently do on a year-on-year basis. In terms of ROIC, well, remember 10% or more, that is what we get in 23, but do bear in mind it has come down all the way from the highs of 35%, and on a trailing 12-month basis, it does sit at the 7% level. Operating margin, well, this is a positive and the negative. Positive to note, it has consistently been pretty strong over the longer term. In fact, 2023 and on a trailing 12-month basis, it has come down. The positive thing to think about here as well is that if they can sort out their margins back to what we've seen over the last few years, then this could really help their bottom line and propel that share price back to the historical levels. Free cash flow margin as well, very strong up until 2023 where we did see negative. And the final metric, the net debt to EBITDA, below 3 is what we want. Below 3 is what we get every single year. 1.97 in 23, 1.78 over the next 12 months, so no worries whatsoever with that balance sheet based on this information. First thing to draw your attention to is Wall Street and their price target. They see 40% upside over the next 12 months, price target of $140.19. And with our margin of safety, as you can imagine, there is a nice MOS, especially if you do believe in the longevity of this company. And in terms of a 30% margin of safety, it isn't quite there yet. In today's episode, it is sitting between 25 to 30 with some very large upside from Wall Street. As always though, do let us know your thoughts about Estee Lauder. It is one that we have covered quite a long time ago when it was crashing, but again, let us know your thoughts if this is attractive. We then have CVS Health, where we have a buy from Wall Street and a hold from the other analysts. It does have a nice forward yield at 4.5%, forward P at 8.5, and as we can see, trading right there towards its 52-week lows, down 21% over the last 12 months. Over the last 10 years, down 23, and we can see all-time highs around 2 years ago at $110, pretty much double the current trading price. Now, in terms of their earnings, what we have noticed is that over the last 4 quarters, 3 of them they have beat, although the more recent one they did miss quite significantly, and over the next 3 quarters they are anticipating negative growth to the EPS year on year. In terms of December 25, well, 8 or just under in fact for the EPS estimate, bringing down the forward P to 7.49. And then in terms of dividend safety, always nice to note a safe score from those that do have an attractive yield, and a very nice increase, 9.9 just in December of last year. Now, when we talk about this company with respect to the last recession, they actually increased the dividend, they had above average growth, and they also outperformed the S&P, so that is a very good sign, especially for those that do see one inbound very soon. As we mentioned, just under 10% last year, 4%, so in line with inflation over the last 5 years, and nice double-digit increase over the last 20. We also note 2 years of consecutive increases with 27 years of paying a dividend without a reduction. In terms of dividend yield theory, well, undervaluation again on the forward P, and triple undervaluation in today's episode, much lower than the healthcare sector at 16.3. In terms of the free cash flow payout, well, very attractive. It has been below 40% every single year over the last 10 years. Free cash flow as well, a little bit inconsistent as we can see, in fact coming down from the highs of 2021, but still has been increasing over the longer term. But we do want to draw your attention that over the next 12 months, it is anticipated to come down to 689. In terms of sales growth, well, as we mentioned, 3 to 7%, and over the last 2 years, actually very strong, double-digit growth, 9% on a trailing 12-month basis as well. So overall, CVS Health do increase their top line at a very impressive rate, and as we can clearly see here, more than doubled over the last 10 years. Now, shares outstanding, bit of a roller coaster. Some years they have diluted your position, some years they have done some share buybacks, but net position over longer term, whilst being marginal, is share dilution. ROIC as well, above 17% if you want to be industry specific for consumer retailers. What we have noted, it has come down, but still 9 to 11% in 22-23 isn't that bad. We on this channel want to see a minimum of 10%, so as long as they can keep it around that level, then it does look to be okay. But as always, we can factor this in to our MOS level. Operating margin, now a little bit of a worry, not the fact that it's below the 10% we want to see, as in this industry it is very tough to have it very high, but the fact it has been decreasing is a little bit of a worry. 4% in 23, 3% on a trailing 12-month basis. The smaller this gets, the more difficult it will be for the company to turn a profit, something to bear in mind. Free cash flow margin as well, a bit of a struggle just to keep up with our preference for the industry. In terms of net debt to EBITDA though, below 3 for consumer retailers, that is what we see in 23, although it is anticipated to go up marginally higher over the next 12 months. As always, this is why we do use a margin of safety. Any issues that you do believe can help if there is a nice MOS level. Now, our intrinsic value at $71 in today's episode with a 10% margin of safety indicates a buy at $64. At 15% around 61, and in today's episode you're not getting a 20% MOS with CVS Health, sitting somewhere between 15 to 20%. Bear in mind as well, you can grab a copy of this model by clicking on the pinned comment below and putting your own numbers in so you can see what you believe the intrinsic value to be. We also note Wall Street do see some nice upside, 15%, their price target $68, and we do believe with the interest rate cuts happening over the next few months that a lot of stocks with very nice yields will become a lot more attractive, and a lot of people will start moving their money out of their savings into the market. We then move on to Pacon, which is just a buy from Seeking Alpha. It does have a yield, although marginal in comparison to the previous, 0.95%, Forward P at around 20, S&P remember at 23. It is also trading towards the 52-week low, absolutely obliterated, down 57% over the last year, and over the last 10 years though, up 1,115%, but we can in fact see all-time highs October 21, so nearly 3 years ago, at $550. In terms of their earnings, well, positive to note they have beaten over the last 4 quarters. However, over the next 3 quarters, they're expecting negative growth to the EPS, but ultimately their earnings per share estimate for December 25 will bring that forward P down to 17.91. When we look at this company, they have just recently paid a dividend, so no dividend safety score as yet, so we will keep you up to date when that does get released. In terms of the free cash flow payout, very nice to note, very low, around the 20 to 30% level. So again, this does give us confidence that increases to the dividend will be very nice. Free cash flow per share looking very strong. This is what we want to see from companies, increasing over the longer term and at a very nice rate. On top of that, expected to continue over the next 12 months. And sales growth, always a great sign to see, double-digit increase year on year. The only question you need to ask yourself is, do you believe that this top line growth is going to slow down, as we can see that decreasing trend? Numerically speaking though, very strong, more than 10 times over the last 10 years. And in terms of shares outstanding, it is very minimal, in all honesty, sitting around 58 million in 2023, but there has been a little bit of share dilution over the longer term. ROIC again looking very, very attractive, 30% in 23, 37% on a trailing 12-month basis. And margins, as always, you know we like to see increasing margins over the longer term, well above the minimums we want to see. Same to be said for the free cash flow margin, 17% over the last 2 years, always looking good, not just above the minimums, but also the consistency. Net debt to EBITDA, you'll probably know what we're going to say, looking very strong over the last 5 years, not even one day to pay off all of their debt net of cash on hand. That is the same expectation over the next 12 months. Then we move on to the valuation. Our intrinsic value at $186 will give a margin of safety. We put it at 10% and that gives us a buy up to around $168. At 15% around $158, which is what it is trading at right now in today's market. So 15% MOS with Wall Street indicating 14% upside over the next 12 months may be enough for you to consider, or maybe you want a little bit more upside and a little bit larger MOS. We then move on to Papa John's, where again another large pick and mix here. A buy from Wall Street, a hold from Seeking Alpha, and a strong sell from Quant. Trading right there towards its 52-week low with a forward yield of 4.44%, forward P of just above 17, and over the last 12 months down 46%, over the last 10 years down 6.5%, so not the greatest. And we can also see all-time highs around 2 to 3 years ago at $133. That is pretty much around 3 times the current trading price. Now in terms of the earnings, very mixed. The oldest 2 they did miss, but the more recent 2 earnings they did in fact beat. Next few quarters, as we can see, very, very mixed. Some quarters growth, some quarters negative growth. But overall, December 2025, with the EPS of 2.8, that forward P is anticipated to come down just below 15. Now, we don't have a dividend safety score just yet, but dividend growth over the last full year, nice double digit at 14%. And when we do look at the historical growth, double digit over the last full year, last 5 years, and last 10 years, something we love to see from the companies we invest in. Then in terms of looking at the payout ratio, very, very high in 22 at 139%, 66 over the trailing 12 months, so that does give us confidence. Remember, below 60% over the next 12 months, anticipated to be around the very similar level. Free cash flow per share, very inconsistent on a year-on-year basis. This may deter a lot of investors as they do prefer to see consistency, but over the next 12 months, we are anticipating massive growth from the prior year. In terms of sales growth though, again, 2 of the last 10 years have been negative. 2020, 2021 looking very strong, but there is a sense of inconsistency with their numbers. And we can see when looking at their top line, it has increased over the longer term, but year on year, there are some growth and some decreases. In terms of shares outstanding, over long term, they have done some share buybacks, but the initial shares outstanding is very small. ROIC looking very strong over the longer term. Some years where it did get quite low, the 29%, 35%, 19% is still very strong for a company in this industry. In terms of margins, something that we want to see consistency and growth, so a little bit disappointing to see the drop from 2018 to 2020, so definitely something to factor into your MOS. Free cash flow margin as well, a lot of inconsistency throughout the numbers. Net debt to EBITDA below 3.5, pretty much where it straddles around over the last few years, something just to bear in mind. And importantly, when we do look at the valuation of this, first thing we want to point out, Wall Street are very bullish in their price target, and they see this as severely undervalued, and it does pay not just a nice yield, but also nice increases to the dividend year on year. 62% upside, 67.43 price target, and our intrinsic value, in all honesty, is a little bit higher at $73. So what does that mean for the MOS? Well, 10% a buy at 66, at 20% a buy at 58, at 30% a buy at 51, and we can see in today's episode there is some significant margin of safety. At 40% a buy at $44, not quite at the 45% level yet, so sitting somewhere between 40 to 45%. As always, give us your thoughts below whether or not any of these are interesting, whether or not any of these maybe you want a deep dive, or they're on the watch list until they do fall into your own appropriate buy zone. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.